Let's look at the fixed income space with Stephen Nash. He joins us from Fixed Securities with us in studio today, and James Dagger-Nixon still with me too. And Stephen, just off the back of chatting with Juliana and the role that these independents now play in the future of the government here in Australia, what do you see in terms of the bond markets and how they think things might play out?
Well, I think the interesting thing is I think we're agreed that we've got more political diversity going forward, and the question is what's the price tag for that?
Yeah.
We've got green issues and we've also got regional issues. There will be requests for spending in those areas. So I imagine that there may be some extension to the balancing of the budget at the time of that, and there may be further bond issuance. I don't think that's a disaster for the market. It's just extra issuance. If anything, it's a positive because it'll give us extra liquidity in the bond market.
We're talking to Tony Rummel from Alpha Investments this morning, and I put to him, you know, what does he think the market would like to see in terms of what form of government? And he suggested that they'd like to see the Liberals, a coalition, take government. That's the market's perspective.
Yeah.
In terms of the reaction for bonds, I suppose, or implications for bonds, what would a coalition government have?
Well, I think the coalition government's mentioned the 30-year bond. I think that's just not a good idea, it's a great idea. I think extending government debt in terms of length would be a good thing for the economy. That would also enable the banks to extend their debt, and corporates as well. I think that would be a big positive.
And for Australia as well, you know, we want to be a financial hub here in Asia. You think that's a step towards that too?
I think it's one of the steps. I think there's got to be a package of policies around the idea of a 30-year bond. But I think essentially a financial centre is centred around the bond market. Obviously, we won't be a huge bond market, anything like the US, but we could still have a larger, a deeper and a longer market, and I think that would be very positive.
Do you think investors, I suppose, particularly in these sort of volatile times now, should be keeping bonds as part of their portfolio as a buffer almost?
Look, I think it's not... right now, I mean, obviously bonds have rallied a lot, and one could say, well, it's a knee-jerk reaction, get more bonds on your portfolio, but I think... I mean, broadly, people should have a fairly high exposure to interest rate risk in their portfolios as a way to absorb shocks. I mean, you can have a portfolio with a low bond exposure and you're going to feel every bump in the road, but if you have more bonds, it smooths your return stream out a lot.
But cash obviously will play a part there as well in terms of smoothing those bumps.
Cash as well, but long bonds in particular really help in these sort of situations we're in right now, where long bond yields have rallied so much. You're getting a lot of benefit from those long bonds.
Just on that rally, and I suppose particularly as you say, the US bond market, because it is so much bigger, there have been suggestions of a bond bubble. I mean, is that possible? Because surely you don't, if the bubble bursts, you don't go to zero, you go back to par.
Yeah. Look, I think, you know, the bond market, like everyone else, is making a best guess. The best guess right now is that recession probabilities are getting towards a third, you know, 33%, something like that. Is that overly pessimistic? I think it's probably about right. I think, you know, even for someone who was bullish a while ago, what's happened with the bonds recently has astounded me. And I think possibly the bond market could be a little bit pessimistic right now. However, I think the bond market is expecting some sort of correction in equities. Now, that could be another 10% down, 15% down. I think bonds would do reasonably well in that scenario, but a lot of it's priced in already. And
people are pricing in the idea of maybe hearing something out of Ben Bernanke on Friday. I think you're kind of seeing in the currency markets, everyone's just waiting to see what he says. But are you actually expecting much? Does he ever say much at the Jackson Hole Symposium in terms of whether he would announce any more stimulus?
I think the market is looking for guidance with regard to the growth outlook. I think there may be some comments with regard to that. We've had a series of revisions down the US, the UK, France, the problems in Ireland and elsewhere, and we've had a series of bad releases in terms of economic activity in the US. So I think the market is looking for guidance. The question will be how much he gives on Friday. I imagine that he will probably lower expectations once more with regard to growth.
Do you think he will... I mentioned, I suppose, the bogey words of double dip. I mean, I heard this morning market pricing in about 40% chance of a double dip recession. He's got to make some sort of comment, doesn't he? At least to ease concerns, if that's the case.
Look, I think he'll, as these statements usually are very balanced, I think he'll demonstrate an appreciation of both sides of the argument. But I think there might be... Well, no, I think there might be some expectation of a lower growth outlook, but not a disaster scenario, and probably no mention of the double dip.
Do you think it was a bad move to use that phrase, unusually uncertain?
Well, I think it's
I mean, do you think he'd repeat it?
I think it probably will repeat that, and then sort of guide expectations a little bit lower on growth, but not dramatically lower.
I think you can get that on coffee mugs and T-shirts now. Unusually uncertain. It's become a little bit of a catchphrase.
It'd be a long-term investment.
But then the case is, what is the usual amount of uncertainty? Yeah.
Yeah, that's true as well. In terms of where things go from here, I mean, at the moment we can only look at Friday and hope for something out of Ben Bernanke. Beyond that, what gets the US out of this low growth / no growth environment?
Well, I think businesses have great increases in earnings of late. I think they have to invest in plant and equipment, and that's going on now. I think we'll see more evidence towards the end of the year of that. I think this whole European growth story that started in May is coming to basically a climatic end, and we'll probably see that within a few months. Once those fears are out of the way, I imagine people will focus on those growing earnings and investment. Hopefully, job growth will improve, although the data of late hasn't been good.
Stephen Nash, thanks for your time in studio today once again. Good to see you. Stephen Nash and James Nixon with me.